Hey everyone, welcome back to Corporate Decoder, the place where we shine a light on the shady corners of corporate filings and sometimes uncover more than we bargained for. Today we are diving into Profusa Incorporated latest SEC filing, which is basically a financial health check and a peek into their future plans. This report is packed with crucial information about where this company stands financially and what they're planning next. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we break down these documents even further, and you can ask your own questions. Alright, let's decode this Profusa Incorporated filing. This is a significant document, folks, because it is essentially them telling the world they want to sell more shares of their company, and they need to show everyone why that is a good idea and what they're up to. So Profusa is looking to sell over 42 million shares of their common stock. Some of these shares are coming from the company itself, and some are from existing stockholders who want to sell. They've brought in Ascent Partners Fund LLC, who will be purchasing or reselling a big chunk of these shares. Now, every company, especially ones looking to raise money, has their risks, and Profusa is no different. They highlight risks related to something called a committed equity facility, which sounds fancy, but basically boils down to the fact that the price and the amount of shares they can sell aren't fixed yet, and the selling of these shares could cause dilution to existing stockholders, meaning your ownership stake gets smaller. Selling more shares, if not managed carefully, can also push the stock price down. That is a big deal for current investors. Let S dig into the numbers, looking at their unaudited, condensed, consolidated balance sheet as of the 30th of June 2025. We see this Profusa itself had about $4.4 million in assets, while Northview, the SPAC they merged with, had about $1.9 million. After the merger and accounting adjustments, the combined company has around $14.6 million in assets. Now that doesn't sound like a lot for a publicly traded company, but remember, this is just one snapshot in time. On the liabilities side, we see accounts payable totaling about $8.6 million for Profusa and $1.7 million for Northview. After accounting adjustments, the combined company has about $8.6 million in accounts payable. This is money they owe to suppliers and other short-term debts. Here is a number to watch convertible debt payable net of discount. Profusa alone had about $49.9 million of this. Northview brought in about $10.2 million. After all the merger accounting magic, the combined company shows about $13.8 million for this line item. This is debt that can be turned into stock, but it also comes with interest payments and other obligations. Now, for the profit and loss for the 6 months ending the 30th of June 2025, Profusa reported a net loss of about $5 million. Adding in Northview and the merger adjustments, the combined company shows a net loss of over $17 million. That is a substantial hit. For the full year 2024, Profusa reported a net loss of over $9 million. These numbers clearly show the company is still in a growth phase, burning through cash to develop its technology. They clearly state they have substantial doubt about their ability to continue as a going concern, which is a serious warning sign. It is interesting to note their revenue. For the 6 months ending the 30th of June 2025, it was zero. For the full year 2024, it was only $100,000. This tells us that Profusa is not generating significant sales from its core products, yet their primary focus is on developing and getting regulatory approval for their bioengineered sensors. To develop these products, they are spending heavily on research and development. For the 6 months ending the 30th of June 2025, they spent over $800,000, and for the full year 2024, it was over $1.6 million. This is a huge investment and necessary for their business model, but it directly contributes to those net losses. They do have some government grant revenue. For the year ended the 31st of December 2024, it was $100,000. This is helpful, but a drop in the bucket compared to their expenses. Let's look at management. Ben Huang, their CEO and chairman, has been leading the company since 2012. Fred Nextel joined as CFO in July 2025, bringing experience from other companies like Diamir Biosciences and Interpace Biosciences Incorporated. Rajesh Asarpatar, another director, has extensive experience in the healthcare sector, having held roles at Ormedics and Nuvasive. Lauren Chung and Peter O'Rourke also bring valuable experience in finance and healthcare consulting, respectively. Jack Stover is also a seasoned director with a strong financial background. Now let's talk about who owns what. As of the 8th of October 2025, Ben Huang directly owns about 844,000 shares. Fred Nextel has a much larger number, over 8.9 million shares, largely tied to his role at Northview sponsor, ILOC. Jack Stover also has a significant holding of over 8.6 million shares, also linked to Northview sponsor ILSC together. The directors and executive officers own about 9.8 million shares, representing 23.5% of the company. Looking at major shareholders Northview sponsor, ILC holds over 9.3 million shares, nearly 22.4%. Ascent Partners Fund LLC holds over 3.4 million shares, which is 8.2%. Jesse Santana owns over 2.1 million shares, making him over 5% owner here. One of the most striking and frankly unusual aspects of this filing is their Bitcoin treasury strategy. They are planning to use proceeds from the committed equity facility to purchase Bitcoin. Now, Bitcoin is famously volatile, as they themselves point out, mentioning it has traded below $53,000 per Bitcoin and above $123,000 in the 12 months prior to this filing. This is a huge risk. They acknowledge that fluctuations in Bitcoin prices are likely to influence their financial results and the market price of their common stock. Concentrating assets in Bitcoin is a bold move and adds a significant layer of risk to an already risky venture. Profusa, main business is developing innovative biointegrated sensors. Their flagship products are Lumi Oxygen and Lumi Glucose. Lumi Oxygen has CE approval in Europe, and they are aiming for FDA approval in the US for wound care management. Lumi Glucose is their continuous glucose monitor, aiming to be more long, lasting and user-friendly than current options. They've invested over $100 million and more than a decade into this technology. They're also eyeing partnerships in Asia-Pacific markets. Protecting their innovation is critical. Profusa has a robust patent portfolio with 20 issued US patents and 80 international patents, along with many pending applications. These patents cover their in vivo sensors, signaling chemistry, and data processing algorithms. This intellectual property is a key asset for the company. This is a critical warning. The company has received a delisting notice from NASDAQ due to not completing a business combination in time. While they move to OTC markets, this is a red flag for investors about the company's stability and access to capital. Their common stock is now trading on the OTC pink sheets, which is typically a less regulated and more volatile market. So what is my take on Profusa Incorporated? This is a company with truly groundbreaking technology in the medical device space. They are investing heavily in research and development and have a solid patent portfolio, which are definite strengths. However, they have significant financial challenges with substantial net losses and a clear going concern warning. Their move into Bitcoin as a treasury strategy adds enormous risk and is a major deviation from their core business. The delisting from NASDAQ is also a serious concern, indicating financial or operational hurdles. For investors, this is a high-risk, high-reward scenario. The technology has immense potential, but the path to profitability and sustained operation is fraught with considerable obstacles. It is a bet on the technology's eventual success and their ability to navigate intense regulatory and financial challenges. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.